I'd like to bring you into the conversation as you sit squarely within the asset management industry, but look at both the retail and institutional side. So when you look at this paper and what it proposes, how should South Africa strategically position itself to attract capital for industrialization? What would, in your case, make sense given the type of practical capital you need to kind of deploy in order to create risk adjusted returns for investors?
Yeah. Thank you, Mosidi. And thank you to the authors of this paper. I think it really brings to the fore many of the critical topics that investors would really love solved for to meet their ultimate kind of dual objective, which is, as you say, kind of meeting those targeted risk adjusted returns, typically, meaningful real returns, but at the same time, sourcing those returns in a diversified manner. And this has really been kind of the nub of issues, particularly for domestically oriented South African investors or investors investing into South Africa, even if you are foreign. Foreign investors, and therefore who is the investor, also matters. Foreign investors are typically looking to South Africa as an emerging market to provide kind of a growth that perhaps might not be available, given the nature of the construct of this market, but also to deliver a form of returns that would perhaps not be correlated entirely with developed markets, as an example. The second thing is that domestic investors tend to be very focused on investing their portfolios, and particularly whether institutional or retail, aligned with almost the weightings of those represented sectors in the benchmark. And if you look at our standard equity indices in South Africa, they are currently, given the rise in, for example, the gold price and the platinum price, currently have quite a high weighting, for example, to commodities. So about a third of kind of the equity benchmark, which is under a third, is commodities. A big chunk to financials, also another third. And then the remaining third is split, quite almost widely between various other sectors, your consumers sectors, your consumer discretionary. But what is significantly underrepresented in our benchmark, which almost is the baseline against which institutional capital invests, are industrial stocks. So industrial stocks, your food producers, they probably, if you add them all up together, don't even get to a double-digit percentage of the South African equity benchmark. And why this starts to become, interesting and potentially a massive opportunity is that we actually are significantly under-indexed to the extent that a country that really represents our potential for growth, where we are in our life staging of industrialization, we really should have a higher allocation to kind of investment opportunities into the industrialized sector. And that's a vast catch-all area. I am conscious, for example, that even in the material sector, really is more gold and platinum rather than your general miners that is dominating that sector. And in South Africa, having been a commodity producing export oriented nation and economy, all those trickle down effects that come from typically when commodities have been in boom have typically shaped how the other downstream industries perform. And so if we really want to move to a more diversified market, we really have to also potentially move to a more diversified economy that is then represented in the public equity space. So for me, the exciting opportunity is if we can almost start to re-index the right share that the industrial almost sector, that we call it the indie sector, should be representing. Because if it were representing larger kind of turnover, larger earnings pool, larger profit center, which it should, you would find that the institutional capital would gladly shift there because it would provide very much diversification benefits. The last point to note for South African investors is that we have this large cohort of, or we call them, non-South African, non-commodity companies that are listed in our market, which actually have no connection to the South African economy at all. And yet they consume a large chunk of institutional capital because they tend to invest alongside benchmark weights. And my sense is that that same capital, particularly given asset owners are becoming a lot more conscious now around the impact elements as to not just the return element, but the impact element of where their capital is going, would gladly seek to find a home in profit centers that are domestically oriented rather than these almost multinationals that are global beverage companies, global manufacturing companies, global, consumer companies. So a couple of almost opportunities that absolutely exist largely for institutional and retail capital if we had almost the right weighting of industrials in the available benchmarks.